Welcome to our deep dive on mastering the 60-day rollover rule so you don't lose your hard-earned retirement money. Today we'll walk through what happens when you receive a lump sum retirement payout, how the IRS's 60-day rule works, and exactly what to do next to avoid taxes and penalties. Let's jump in and keep your retirement on track. Here's the plan for today. First, we'll clarify what distributions are and why they don't count as contributions toward annual limits. Next, we'll unpack the 60-day rollover rule. Then we'll tackle the 20% mandatory withholding and how to handle it. After that, I'll give you a step-by-step rescue plan. We'll also compare rolling into an IRA versus a 401k. Then, we'll reinforce your understanding with quick diagrams and examples. And finally, we'll test your knowledge with a short quiz. If you received a lump sum payout from an ESOP or a corporate acquisition, that money is treated as a distribution, not a contribution. This is crucial because distributions don't count against annual contribution limits, and mishandling them can trigger immediate taxation and potentially penalties. Consequently, the right move is to roll the funds properly and on time to keep them tax-advantaged. With that in mind, let's move into how the 60-day rule works. Before we go further, a quick but important disclaimer. This video is for educational purposes only. It is not tax, legal, or investment advice. Individual circumstances vary, so consult a qualified tax professional or your plan administrator to confirm the right steps for your specific situation. An indirect rollover occurs when you receive a retirement distribution in your own hands, typically as an ACH or check, and then you deposit it into another eligible pre-tax account yourself. This is distinct from a direct trustee-to-trustee transfer, where the money moves directly between institutions. Remember, this distribution is not a contribution and therefore doesn't count toward annual contribution limits. To preserve tax deferral, you must complete the indirect rollover within 60 calendar days of receiving the funds. If you miss that window, the entire distribution becomes taxable and may be subject to early withdrawal penalties depending on your age. The diagram illustrates the key branches. Act within 60 days and deposit the gross amount to a traditional IRA or 401k, or miss the deadline and face taxation and potential penalties. It also shows that 20% federal withholding is common and must be accounted for in your redeposit. You later reconcile the withholding on your tax return using Form 1099-R. Let's compare direct and indirect rollovers. With a direct rollover, also called trustee-to-trustee, the funds move directly between institutions. There is no 60-day deadline, and typically no mandatory 20% withholding. This path is simpler and reduces the risk of error. In contrast, an indirect rollover places the funds in your hands first, triggering a strict 60-day deadline and often a mandatory 20% federal withholding. That creates logistical challenges because you must deposit the full gross amount, including the withheld portion, to complete a successful rollover. As a result, indirect rollovers carry higher risk and require more careful execution. Now about the timing. The 60-day period begins the day after you receive the funds. These are calendar days, not business days, so weekends and holidays count. To be safe, aim to complete your deposit well before day 60. The money must land in an eligible pre-tax account, typically a traditional IRA or a 401k that accepts rollovers, by the deadline. As we transition to taxes and withholding, remember that speed and precision matter. Many employer plans withhold 20% for federal taxes on eligible rollover distributions. If your gross distribution was, for example, $100,000, you might only receive $80,000 in your bank account while $20,000 is withheld. However, to complete a successful rollover, you must deposit the full $100,000 into the receiving retirement account within 60 days. That means you typically need to add personal funds to cover the withheld portion. Later, when you file your tax return, you will claim credit for the 20% that was withheld as shown on Form 1099-R. Next, let's go step by step through a practical rescue plan. Here is a clear rescue plan. First, confirm the exact date you received the funds and count 60 calendar days from that point. Second, if your employer plan's processing times are slow or the plan doesn't accept indirect rollovers, open a traditional IRA immediately to avoid missing the deadline. Third, redeploy the full gross amount, including the 20% that was withheld, using personal funds to make up the difference. Fourth, send the money as quickly as possible. Wires or ACH transfers are typically faster than mailing checks. Keep detailed documentation, account statements, confirmations, and all date stamps. Finally, when you file your taxes, include the 1099-R and claim the withheld amount as federal income tax withheld. Now, to make this concrete, let's look at a quick numbers example. This table walks through a $100,000 distribution. The plan withholds $20,000 for federal taxes, so you receive $80,000 in cash. To complete a valid rollover, you must redeposit the full $100,000 into the IRA, or 401k. That typically means adding $20,000 from personal funds to make up the difference. Later, when you file your tax return, the $20,000 withheld is credited to you, typically resulting in a refund or reducing taxes owed, depending on your broader tax situation. Next, let's decide where to send the funds to minimize risk and delay. When the clock is ticking, a traditional IRA is usually the fastest landing spot because it's quick to open and fund. Some employer plans do not accept indirect rollovers or have long processing times, which could jeopardize your 60-day window. Therefore, protect the deadline first by depositing into a traditional IRA. If you ultimately want the funds in a 401k, you can later execute a direct trustee-to-trustee transfer from the IRA to the 401k, provided the 401k accepts roll-ins. This sequence reduces risk while keeping your long-term plan intact. Now let's visualize the decision process with a mind map. This mind map organizes the decision process. Start at the center with distribution received. One main branch is time left, which splits into greater than or equal to 20 days and less than 20 days remaining. If less than 20 days remain, the safest path is to open a traditional IRA immediately and use a fast transfer method like wire or ACH. If 20 or more days remain, check whether your 401k accepts indirect rollovers. If yes, confirm paperwork and deposit the gross amount. If no, use a traditional IRA first. Another branch addresses the mandatory 20% withholding. Replace it with personal funds to deposit the full gross amount, then claim it back via your tax return with the 1099-R. A documentation branch reminds you to keep confirmations and date evidence. Finally, after you complete the rollover, you may consider a direct rollover from the IRA to a 401k later if desired. Here is a quick checklist you can use right away. First, confirm your day 0 receipt date and calculate the day 60 deadline. Second, choose the fastest landing account, usually a traditional IRA, if your 401k's processes are slow. Third, line up personal funds to replace the withheld 20% so you can deposit the gross amount. Fourth, initiate your transfer early and prefer faster methods like wire or ACH. Fifth, save all confirmations and timestamps. Sixth, file your taxes correctly and claim back the withheld amount using Form 1099-R. Now, let's test your understanding with a short quiz. Quiz time. You received a $50,000 distribution and $10,000 was withheld. How much must you redeposit within 60 days to complete a valid rollover? Option A, $40,000. Option B, $50,000. Option C, $10,000. Option D, $60,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $50,000. You must deposit the full gross distribution amount within 60 days, including the withheld portion, to preserve tax deferral. Later, you claim the withheld amount on your tax return. Let's move to one more quick question. Here's the next question. You're on day 48 and your 401k plan has slow processing times. What's the safest destination to protect the deadline? Option A, traditional IRA. Option B, your checking account. Option C, Roth IRA without a formal conversion. Option D, your current 401k plan with slow processing. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is traditional IRA. When time is short, an IRA generally offers faster setup and processing, reducing the risk of missing the day 60 deadline. After the funds are safe, you can later consider a direct transfer to your 401k if desired and permitted. You might wonder about exceptions if you miss the deadline. There are limited forms of late rollover relief, such as self-certification for specific qualifying reasons. But approval and applicability are not guaranteed. The simplest and safest strategy remains to avoid delays act fast, and document everything. Now let's capture the most important takeaways. Here are the key takeaways. First, distributions are not contributions, and mishandling them can trigger taxes and potential penalties. Second, the 60-day window uses calendar days, and there are no extensions for weekends or holidays. Third, you must redeposit the full gross amount, replacing the withheld 20% with personal funds. Fourth, when timing is tight or uncertainty exists, a traditional IRA is usually the fastest safe harbor. Fifth, keep thorough documentation and claim back the withholding on your tax return using Form 1099-R. To wrap up, confirm your receipt date and count 60 calendar days. Protect your deadline by using a traditional IRA first if plan processing is slow or uncertain. Deposit the full gross amount, keep every confirmation, and claim back the withheld taxes on your return. Following these steps dramatically reduces the risk of accidental taxation and penalties. Thanks for watching. If this walkthrough helped you protect your retirement money, please like the video, share it with anyone who might be up against a rollover deadline, and subscribe for more practical guides. Drop your questions or scenarios in the comments, and we'll tackle them together in future episodes.